Welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Sundeep Bajikar. Sundeep is a portfolio manager of the Acteve Model Portfolio. He was a Wall Street analyst for 9 years at Morgan Stanley, and he spent the 9 years before that in the technology industry at Intel. He holds an MBA in finance from Wharton and master's degrees in electrical and mechanical engineering from the University of Minnesota. Today we're going to be discussing his book, Equity Research for the Technology Investor. Sundeep has found an interesting way to marry value investing with technology stocks. Let's ask him 5 good questions. All right, welcome back to the show, everybody. My guest today is Sundeep Bajikar. I said that right, didn't I?
You did, great.
Perfect. So Sundeep is the author of the book, Equity Research for the Technology Investor. And which I found really interesting about this is that basically you have this dichotomy of sort of value guys and then technology guys a lot of times. And what was interesting to me about Sundeep was that he was able to marry the two together. So Sundeep, you ready to jump right in?
Yeah, I'm looking forward to it.
Okay, perfect. So question number 1, if you're a generalist investor, which is what I would consider myself, do I really have any business wading into the waters of technology investments? It seems like I might be setting myself up for failure, venturing outside of my circle of competence very quickly. Or is that the exact mindset that often creates the opportunities?
Yeah, I think it's a great question. I'll try to cover all the different pieces of it from my perspective. I think that if you're a value investor, I think the short answer from my standpoint is no. And I think the long answer is maybe if you think you can build deep knowledge of the particular industry sector. Now, within the technology space, it's not homogeneous, as you know. There is a range of difficulty. You have semiconductor and semicap equipment on the one hand, and I think that's probably where the most of the difficulty lies, and it's probably the highest level there. And then you have hardware, you have software, and then you have internet and a number of other sectors, which I think most generalists can probably understand relatively easily. So within the semiconductor space, again, you have varying levels of complexity. And I would assign probably the highest level of complexity to investing in the memory space. So my favorite case study that I've used extensively in my book is Micron Technology stock. So within my process of value investing, I actually place a lot of importance on forming a strong understanding of the underlying industry dynamics, because knowledge of the industry serves as the basis for coming up with your margin of safety assessment. Because from my perspective, in the absence of industry expertise or knowledge, you're basically missing a big piece of the puzzle. And then you would struggle to form basically a complete understanding of the risks involved. So in this scenario, you can get lucky, but you can't really claim to have a good assessment of margin of safety. So, of course, the majority of market participants do not have technology industry expertise. And for that reason, from my standpoint, I don't think they're necessarily able to form a strong understanding of the industry dynamics. And this is, in fact, what consistently creates opportunities to generate alpha, and which is why I got into the business myself. So I guess another way to say it is I think that when it comes to technology stocks and value investing, I think the bar is low, which is a good setup for me.
Okay. And so with when you're, a lot of times an investment hinges on being able to sort of predict or normalize what earnings may look like 3 to 5 years out, let's just say. How do you get comfortable with figuring out maybe what potential earnings are going to be? Obviously, there's a competitive space aspect to it to see, like, if you're in a really, if there's 20 market participants who you're all fighting for the same business, like it's going to be very difficult to earn more than your cost of capital at that point. But what's your process for kind of teasing apart some of that? And I imagine what the real trick is, like getting the right inputs into your model, basically, right?
Yeah, and I think you answered half of it yourself. So I think my process is made up of two parts. The first one is what I would characterize as a relatively commodity element. And so that involves basically setting up a company model, with segment data, product data, all the stuff that you can generally find from the filings with a little bit of work. Some companies like Microsoft do really nice job of making it easy for their analysts by providing starter models, etc. But most companies don't. So you have to kind of get through that initial hurdle. The reason I call this a commodity element is that with new market data services, and I use the example of Sentio, which is something I use a lot of the model work is actually already done for you. So I'm starting to move away from having to build, full-blown models on my own. And very soon, I think what's going to happen is the need to hire a financial analyst just to build a model is probably going to go away. And that brings me to the second part of the process where I think a lot of the value is created for me. And that's industry analysis. Figuring out industry structure, growth rates, market shares, profit pools, specific technologies, their long-term direction, and coming up with a thesis of where things are headed over a multi-year time frame is really what becomes a major differentiator in my investment thesis. And this is something I call proprietary insights. And I use the word proprietary just because it means that there's a lot of effort and investment value associated with developing these insights. And of course, the average investor is unlikely to have the time or be able to get there on their own. And so for generating these proprietary insights, I often look to attending industry conferences, talking to experts, and then coming back to the models to just tease out the key messages, because the models are really going to tell you what you want to see. The models aren't going to give you insights independently. You have to go outside of the comfort zone to get the insights. So I guess my point is that mechanical analysis can be worthless if it doesn't generate investment insight. And when it comes to technology stocks, generating those insights can be really hard without the industry expertise.
Right. So you just have to know what you're doing, basically, like any investment, really. So that's a pretty good segue to question number two. Talk about attending different events and looking for different resources. When you're kind of, let's call it real world testing your hypothesis and kind of the key drivers of your model, let's say, you're discussing this investment with people outside, potentially. How do you balance the difficulty between gathering information or tainting your investment process in the results of seeking outside input?
No, that's a great question. So again, I think I've sort of probably offer a two-part answer to that. I think the first part is just my own specific training. As you know, I've spent nearly a decade as a sell-side analyst. And, in that job, I was responsible for first coming up with an investment thesis and then engaging in dialogue with my clients who were buy-side analysts. And so, oftentimes it was kind of a one-sided dialogue. A lot of times it was an argument or negotiation, as the case might be. So this is something I've sort of been doing for a while. And at this point, it comes naturally to me. What I've found that is the most valuable discussions are those where you have a lot of disagreement and sharing of opposite ideas. If I'm walking into a room and if I'm agreeing with everyone who's there, unfortunately, I'm wasting time for both them and myself. Because this discourse of opposite ideas is really helpful for refining the thesis and building conviction. The second point I'll make, as I described in my book, and I think I might be way out in the contrarian side on this one, is, and I've emphasized this through my new investment firm as well, is I believe transparency is extremely important for superior performance, particularly in technology stocks. By actively sharing investment theses with clients, there is actually a better chance of catching your mistakes earlier, or at least not repeating some of the mistakes that you might have made previously. If I look at the majority of investment managers out there, and I think this is probably a part of the genesis of your question, I don't see a huge focus on transparency. Certainly not to the extent that I believe in. So I'm quite happy where I stand on that at that topic. I've given it a name, and that name is mindful investing.
That's a hot word right now. Everyone wants to be more mindful.
Is it? Good.
So question number 3, there's so much data out there, more data every day. How do we make sense of all this data? How do we sort through this, especially in the technology area where there's I think a natural disposition from technologists to want to capture more data than even anyone else out there.
Yeah, I think that, so I alluded to this, in terms of describing my process, building models, and then going out, seeking out industry experts in a fashion that I know other investors are not doing. But there's an important other aspect of this where to a certain extent, you have to sort of shut out information. There are lots of news services, alerts, there's a lot of information noise out there, and that can interfere with the process, if only by taking away your time trying to process and make sense of each of these. My experience has been that the vast majority of these updates that I receive, in spite of shutting out a lot of updates, are useless. And so, occasionally, maybe, once in 100 times, I'll find something that says, oh, okay, that's an interesting take, or that's something I didn't know. But if you're doing the work, if you're going outside of your office, and if you're meeting people in the industry, and if you're actively refining your models, then I think the chance that you're going to be surprised by one of the news wires, I think, is pretty low.
So it's that information, by the time it works its way through the network and gets to you, is pretty stale, basically.
Yeah. More often than not, I think.
So question number 4, and when I think about technologies over a longer period of time, airplanes, cars, radio, typically most of the value has flown through to the consumer. We went from, I think there were 2,500 auto companies in the U.S. in the 1920s down to, call it 3 by the 1970s. So there was a lot of zeros out there for investors. So given that it seems like most of the value does go to the consumer and not necessarily to the producer and or owner of the business, how do we avoid that as an investor?
Yeah, I think that's a pretty deep question, and I think it strikes at the philosophy of value investing. I guess I would say 2 things. First, as you know, the purpose of any business is to solve a problem and add value to consumers' lives. So the fact that consumers are benefiting from the product or technology is not a bad thing. In fact, it is very desirable.
For sure.
Unfortunately, if a business is doing a great job adding value for consumers, that doesn't necessarily mean that it is always a great investment to buy or own. And that's, I think, what brings me to the second point, which focuses more on value. And I'm sure you've heard this from other value investors. It's difficult to find value in companies or investments that everyone is familiar with or excited about, because all of that common knowledge and excitement usually translates into higher valuations.
Sure.
And higher valuations are a recipe for poor returns when it comes to investing. So this idea of investing in what you know has been popularized by some people, and it sounds easy, but this is actually quite challenging from my standpoint, especially when it comes to technology stocks, because people come to the table feeling like they might know something that other people don't. And that's treacherous because it gives them a false sense of confidence, and it encourages them to take risk that they shouldn't be taking.
So what would you think the maybe smaller individual investor could do to help mitigate that?
I think from my perspective, the message to the individual investor is very clear, and that is to stay away from investing in individual stocks on your own. So you can do this only if you have an advisor service from a trusted and qualified investment advisor. Because the key element, there are lots of elements in finding good investments. One of the key elements is valuation. And valuation, as you know, is not science. So you can't just look at a bunch of numbers or run them in a spreadsheet and say, oh, this is cheap or this is expensive. I mean, much of the process in value investing is coming up with intrinsic value, except nobody tells you how to come up with an intrinsic value.
Yeah.
Just doing a DCF doesn't necessarily get you there. In fact, I hardly use DCFs. So I think that ultimately what makes a difference in the process is by having a robust, consistent, and learning process. And as an advisor, you can't really promise your clients anything more than that. All you can promise is really a robust and mindful process. So I think it goes without saying that the process also has to be transparent, because this is how people will try to understand it. So what happens is when you layer in all of these different requirements, I think individuals are probably going to be able to blow through a list of advisors pretty quickly. So that, I think, ends up being the challenge, is if you want to invest in individual stocks, you really have to look to somebody who you can trust.
So question number 5, as you're kind of handicapping the future a little bit, looking out and trying to assign different, not only the probability of an outcome, let's say in a competitive space, but also the magnitude of that event, or the interplay of companies fighting for market share, let's say. It seems to me like technology has an even harder time, or technology doesn't lend itself well to that type of handicapping, because a lot of times it obeys power laws that us humans are just not that good at projecting. We're very linear minded. So how do you try to get yourself into the ballpark of what the future might actually kind of look like, given all of these factors?
Yeah, that's a pretty important and deep question. So let's see if I can do justice to the answer, because it does strike at sort of the heart of my argument for industry specialization. There will always be some outcomes that are just binary and difficult to call. So let's kind of put them aside for a moment. Because for the rest of the scenarios, my focus is typically to identify these secular multi-year trends. And I use the word trends with caution because it does sometimes carry a negative connotation amongst investors. When I say trends, I'm referring to deeper changes in the industry, changes that'll be virtually invisible to the casual investor. And I'll give you a couple examples. These are also highlighted in my book. The first one is the deceleration of Moore's law cost reductions. And this is a semiconductor-specific dynamic. The other example is wireless base station transition to lower cost components, right? I mean, this is going to sound like a foreign language, but from my perspective, so if you think about the deceleration of Moore's law cost reductions, that actually serves as the key element of the thesis that I presented in my book for Micron, because it actually mitigates the effect of competitive threat. Mm-hmm. And if you haven't done the work, you're never going to find a way to believe this. So this, I think, remains an area which is probably still misunderstood by investors. So that's one example. The second one, this wireless base stations moving to lower cost components is a dynamic that I uncovered through industry research a few years ago. Of course, it wasn't visible in any company's reported numbers or anything like that. Signs of this dynamic started to appear only several months later in the form of good results for Cavium, which is a company I was covering at the time, along with decelerating results for another set of companies like the FPGA makers. So for both of these dynamics, I wrote research reports during my time on the sell side, and I remember investors were very highly skeptical, right? So from my perspective, analyzing the industry is required to come up with better qualitative assessment of the probabilities of the different outcomes. And without that industry analysis, you really have an incomplete basis to form good judgment. And it really, from my perspective, it just really undermines the value investing process.
So would it be safe to say, as kind of a summing up of our whole interview, basically, that you have to know what you're doing, which requires a lot of work and being willing to put in the work to figure out these, get within your circle of competence within technology, but that it also might be potentially ripe soil because it seems like such a daunting task to get on top of it, and maybe it's actually not. It's not impossible. Is that
Nothing is
fair?
impossible. It's a very nice summary. Yes, no, I agree with it.
Okay, and so our bonus question we always ask everybody is for a book recommendation. And what do you have for us today?
So I recently read Howard Marks's book. Now I should have read this a while back, but I just recently got to it. The Most Important Thing, and I loved it. I would highly recommend it to any investor. I do think that value investing itself is kind of underrated, even though Howard's book is probably not. In any case, I would like more people to read it. I think what's great about the book is it ties in with the rest of our discussion, is that anyone can really read it without having financial training.
Right.
And the other thing that's great is that it provides a very nice framework for thinking about investment philosophy and risk without getting too technical or mathematical. Because a big problem I think we have today is that business schools and other types of financial marketeers have spread what I consider a relatively incomplete or even toxic definition of risk, in which risk is defined as volatility.
Right.
An argument is then made that to generate higher returns, one has to take higher risk. Right. So Marx's book, I think, does a very nice job of pointing out the flaws with the conventional model of risk and an understanding of how different definitions of risk can change your investment philosophy completely. I think will be eye-opening to anyone that reads the book.
Yeah, I agree. It's an all-time favorite. I mean, just keeping your investing head game right. There are few books out there that are more helpful and also just digestible.
I agree.
Well, Sundeep, I really appreciate you coming on the show today. It was really fascinating to learn more about technology and how maybe we can pair that together with value investing.
Thank you very much for giving me a chance.
Absolutely. Thanks for watching. I hope you enjoyed this interview. If you'd like to support this author and purchase their book, click here. If you'd like to become a subscriber to 5GQ, click here. And I included a couple other interviews that you might appreciate right here. Thanks. Happy reading.